Hello and welcome back to the channel. So one of my stocks in my TFSA dividend growth portfolio is down tremendously since my last update. So Algonquin Power has tanked, going from $15 all the way down to $10. So that's about a 30% drop just this month in November. So very bad performance from this one holding. Luckily, I have a diversified portfolio, and here is the benefit of it. If one of your stocks unexpectedly underperform or the market just sells out of it, you're not financially devastated by that one stock underperforming or just surprising you and blindsiding you. So if you want to follow along with my my buys and sells from week to week in my investing account, you can just feel free to hit that like button, subscribe to the channel, leave a comment in the description below, and I'll get into Algonquin Power and what my plans are with the stock. So let's roll the intro. Here's the overview of my two accounts that I have with WealthSimple Trades. So I have an RRSP, which is up 25.8%. So in this one, I just hold one stock. It's only Starbucks. And the reason I put it into my RRSP is because I plan to just hold this for a long period of time, reinvest the dividend. So by putting an American listed stock in my RRSP, I will keep 100% of my dividends. I don't have to pay a 15% withholding tax, which is just taken from your dividends if you have a foreign holding in a Canadian investing account. If it were my TFSA, I would have to pay 15% withholding tax. So that's why I set it up like that. And I do get to lower my taxable income for the year for any contributions I make into this account. So there are some benefits for me doing it. I'll probably be adding more to this in December. I may be buying more Starbucks, or I might buy SCHD. I haven't really decided yet, so I'll keep you posted when that happens. For the TFSA, we have a lot more positions, so a lot of individual Canadian and American stocks, a couple ETFs thrown in there. But we're down in this one by 3.66%, so down $671, and I'll just be getting into the TFSA. So in the TFSA, we're up about 3%, or up $500 in the last month. In the past day, we're up $71, so not too bad of a Friday. And then again, the all-time down 671.67, so only down 4%. I consider this fairly flat, especially considering that the broader markets have sold off immensely, and you have the S&P down 15-20%. So overall, we're not doing too bad considering the overall market that we're in. So if we look into the portfolio, I have Apple as one of my largest holdings, so we're in the green on this position by a little bit. Algonquin Power and Utilities is the big loser of the portfolio, definitely my worst performing position. So they announced some pretty unexciting earnings for Q3, so let's get into that. So for 2022, the net revenues increased by over 2021, but the net earnings was lower. So a lot of losses in the income statement for this quarter in 2022 compared to the same quarter of 2021. So it's definitely scaring investors. They noted on the earnings call that they're having trouble not only with inflation itself, but also with the increasing interest rates. Because as you know, in the Federal Reserve in the U.S. and the Bank of Canada are raising interest rates to try and stop and slow down inflation to a more manageable level. In Canada, it's still at 6.9% for the month, so it's unchanged from October and September. So that's definitely affecting AQN. I believe that some of their debt is fixed rate. So it's not affected by interest rate hikes, but about 20% of their long-term debts are variable. So increasing interest rates do hurt this company, hurt their profitability, and will cause pain and cause it to have trouble growing. At least in the short term. I think they should really focus on paying that off. So another field I like from here is the adjusted funds from operations is increasing. So from 170 million to 205, and the dividends declared 123. So it looks like they can pay this dividend at least from their funds from operation. But again, a net loss is never good to see in a quarter. I'll get into the letter from the CEO. So since the stock has tanked, the CEO of AQN has issued a letter to the shareholders. So we'll just read the highlighted portion. So Algonquin remains focused on driving sustainable, long-term, profitable growth that supports an investment-grade credit rating. Our dividend is an important component of our total shareholder return. So just focus here that he bolded that they're concerned about their credit rating. So that signals to me maybe they're going to focus on paying off their debts just to maintain a good credit rating, because as you know, the better your credit, the lower the cost of capital. When you borrow money, you pay a lower interest rate with a better credit rating. So that's very important for a utility like this to maintain a strong credit rating. And then, the dividend portion not bolded. So that's something you want to, kind of read between the lines there, that it's important, but a lot of people are speculating that AQN is going to cut their dividend potentially. So that's part of the reason why the stock has tanked, kind of preemptively. You can consider it pricing it in, a signal from the market, just pricing it in. And they also mentioned on the earnings call that the payout ratio might hit like 80-90%. So that's pretty high. That's not going to leave them a lot of room to like pay back debts. It's not going to leave them a lot of room to grow. So it is possible that we might get a dividend cut, just so the company can improve their balance sheet, and we'll see if that generates good returns. But I can definitely see why people are definitely running for the exits in this one. There are some risk factors here. So he also mentioned that their regulated business continues to be a primary growth driver. So they have 1 million customers in the U.S., Canada, Bermuda, and Chile. So their regular utility business doing great. They're also going to be closing the Kentucky Power acquisition, which they bought. So that should be expected to close sometime in, I think, January of 2023 is when that's going to close. So that should add a little bit of cash into the business, a little bit more cash flow. So yes, making this huge purchase of $2 billion is definitely gonna hurt in the short term, but it will add to the bottom line. And then with that, he said, as the industry continues to see an energy transition, we believe we are well positioned to contribute and benefit from decarbonization transformation. So because a large portion of their company is already set up for the renewable space, they have a lot of renewable infrastructure already. As the government issues more restrictive and tighter regulations on carbon emissions and such, AQN could really benefit from that in the future. By either getting tax subsidies or just not paying the same amount of tax as other utilities that don't have quite as robust of a renewable segment. And then he also said that he strongly believes in the company, and rather than just saying that with words, I think he proved it with action. So he purchased a total of 131,000 shares on November 14th and 15th. So you can do the math at about $10 a share. He put in about $1.3 million into AQN. So that does signal some confidence in the company. And, I don't think the CEO of the company or of any company is out to lose money. So, I mean, it's good that he did that because it kind of stopped the stock from falling further. We'll see if that continues in the future. But generally, insider buying I would see as a positive, but you could view it in the other perspective where he's just trying to calm investors down by putting money down just to keep the stock price higher. So you can look at this as a good or a bad thing. I'd lean towards this is a good thing because I don't think anybody wants to lose money. So the fact that he's making this investment, kind of a good sign to me. I've also made a little bit of a spreadsheet just to track AQN over time. I'd say one of the largest criticisms about this utility company is share dilution, which is just issuing more stock or more shares in the company and giving you, the shareholder, less and less ownership of the company and its future cash flows, because that's what you ultimately own in the end. So I just looked at some data. Keep in mind 2022 isn't complete yet, so these numbers are not finalized. There's still one more quarter. We're only up into the third quarter of earnings for this earnings season. So I don't have the complete numbers for 2022, but just going by the shares outstanding for 2020, we were at 597 million. In 2021, it went up to 671. So they diluted us by 12.4% by issuing that many more shares. So far in Q3 of 2022, we're up to 678 million shares, so that's about a 1% dilution. I know on the earnings call they mentioned that they have about $2 billion of liquidity, so they won't have to issue any more equity, which is just a fancy way of saying, they're not going to issue more shares or more stock in the company to help fund future purchases. So they have access to some money. So that's good. I mean, we're not getting diluted. And then the AFFO is kind of like the free cash flow for utilities. Also real estate investment trusts. So this is where you really want to pay close attention. If this number is not increasing over time, then that's a big red flag. That is not a company you want to own for the long term. You cannot get growing dividends if they do not grow the bottom line and what they actually earn, because dividends are paid from cash. If the business does not make cash, if it does not grow its cash, avoid it. So for 2020, 600 million in AFFO. For 2021, it grew 26%. So we can see that the funds from operation increased at a higher rate than the dilution. So I can kind of think of AQN kind of like a real estate investment trust, but instead of buying like properties that they rent out to people, they just buy utilities and they rent out power. It's kind of a similar concept if you think of it that way. And then for 2022, again, year not over yet, but 588 so far. They should be able to increase this number. So we'll see what they do in Q4. But generally, like a pretty good trend here. The AFFO is increasing faster than the dilution. So that's pretty good. And keep in mind, they are getting Kentucky Power. So that's another thing that's going to add to their bottom line. That's going to be more revenue going into the company because they didn't buy a company that doesn't produce anything for them. They're going to get a lot of customers in Kentucky paying for power. That should help with the bottom line and help them get this debt situation out of control. I really think they should focus on paying down their variable rate debt, because if we do keep increasing interest rates, yes, those interest rates are going to their interest rates that they're paying back to their creditors is going to increase over time. So I think get rid of that. Like I kind of think of it like a household, right? It's like if you have multiple credit cards and a line of credit that you owe money on, you should focus on paying the highest interest debt first, because you're going to save on a lot of interest. So same thing with a business. It's no different. You really should think of it in that sense. For the dividends paid, so in 2020, they increased the dividend from 344 million to 423. So that's an increase of 18.6% more dividends paid. But keep in mind the funds from operation increased by 26, so they could cover that increase in dividend payments. Now, again, no numbers for 2022. We'll just compare 2021. I'll get back to this sheet when they announce their Q4 earnings and kind of take a look back here and see what's happened. Now, the payout ratio is another thing you want to look at if you're a dividend investor. It's very important to look at this field. So, because if the payout ratio is too high, there's a risk that the company will cut their dividend, we don't want that as a dividend investor. That's the last thing you want, because you're trying to build a passive stream of income to replace your active income over time, live off of it, or just supplement your income, whatever your financial goals are. I don't know what those are, so you really need to determine for yourself whether any investment is right for you. I can't possibly know that. So everyone's age, circumstance, and goals are different, even their health. So that's going to affect, how you should invest and what you should invest in. So I'm not telling anyone to buy Algonquin Power. Do your own research, decide for yourself. I'm going to be continuing buying it, but it's totally up to you if you want to do it yourself. So the payout ratio has been increasing. So from 2020 to 2022 so far, we went from 57 to 61. So that's not a great trend to see, and it could go even higher, especially if their funds from operation is mainly going towards repaying their debt. So that's another thing that we want to keep in mind. So they might be suffering in the short term. So I'd say if you want to get into this one, and you're a short-term investor, I'd say avoid this one. I think there are companies that are, not really struggling. Like there's a lot of companies that, everything is just going right for them. Whereas AQN right now, the interest rates are hurting them. So that's one thing you want to consider. There's a lot of investments out there. You can basically reject most of them and just focus on the ones that are right for you. If you don't want to research or delve deep into stocks, this is a great reason why ETFs are fantastic, because you can just continue buying them from month to month and not worry about it, because if one company goes bankrupt in an ETF, it doesn't matter. You have 50 stocks, hundreds of stocks, thousands of stocks in them. So it's one of the benefits of doing that. So for long-term debt, so this field, I want to pay close attention to. I don't like this field, because we can see that the debt has been increasing. I mean, that's normal. They're going to get more assets, but their liabilities are also increasing. So they are borrowing money to grow their assets, which should theoretically create more value. But if you look at the shareholder equity, it went up from 2020 to 2021 from 8.6 billion to 10.58. But then if we look at 2022, it's actually decreased. So 17.6 billion in assets and 10.5 in liabilities. That means that if you were to buy AQN, sell absolutely everything, all the assets, pay off all the debts, you should end up with around $7 billion of value. And the market cap of AQN is about 6.9 billion. So from that, we can kind of gather that, AQN might be fairly valued because, you're basically paying the market, a fair market price for it. So even though it's declined immensely, you could make the argument that it's fairly valued at this point, which is possible. So I'll let all of you determine, what a fair price for AQN is, but that's just the NAV price. So the net asset value is long-term debts minus liabilities, gives you the total value of the company. Just pretend you're buying the entire company and selling off all the assets, and the final number is what the true worth of, what the company owns. Plus any cash they have on hand, but for simplicity, we'll just leave it at this number. And then for Q3, we can see their AFFO was 205 million and the dividends paid were 123 million. So that's a payout ratio of about 60%. So in my mind, I don't see imminent disaster for this company. I definitely want to pay attention to debt. So that's going to be very important to keep track of. You also want to keep track of shares outstanding, AFFO, the dividends, and the payout ratio. These are probably the most important fields for me. I'm not as concerned with revenue growth, because revenue growth doesn't matter if you can't capture any profit from it, right? Like you can make $1 billion in revenue. If you have no gain, if you have no profit, who cares? You didn't make anything as an investor, because you're being paid a dividend. Like this is a dividend stock. And if there's no profit being made, you're not going to get your dividend. Your dividend is at high risk of getting cut. Dividends are not guaranteed. And you need to make sure the companies that you are picking, if you are buying individual companies, can afford to pay you dividends and continue to grow them in the future. So just look at their business models. Are their profits increasing every year? Good. Then that probably means you're going to be getting a higher dividend each and every year. So I'm going to continue to buy AQN. I'll buy a little bit here and there just because I think it's trading at a pretty decent price. And some of the issues are, construction delays due to solar panels. They just can't get them to the United States. So there's a real problem finishing some of their constructions. And again, if you don't have your infrastructure set up for some of your constructions that you're just building, that's definitely going to hurt the bottom line because you don't have a cash flow producing asset until you finish whatever you're building, a plant, a wind farm, whatever it is, it needs to be finished. So that is definitely giving some short-term pain to AQN. But once those constructions are finished and that acquisition comes through, there's definitely some good things that can happen here with AQN. The only danger I could really see would be if they didn't focus on paying down their debt, especially their variable rate debt. They really need to work on that. So I really want to see management make a focus on this and improve the balance sheet, because that's my biggest area of concern right now. Not anything else, not the shares outstanding, not the AFFO, not the payout ratio, not even the dividends paid, but just the debt overall, because this is what sinks you. So the only way for a business to really go, to zero or broke is with debt. So that's the most important thing that you want to look at. Continuing on with the portfolio, ATD is in the green. So this is our global convenience store company with gas stations that, they might convert to fuel charging stations for electric vehicles in the future. So really cool company. Definitely one of my favorites in my portfolio. This is my consumer staple, consumer defensive stock. Aritzia is the all-star of the portfolio, just absolutely crushing it. It's up 34%, so this is our best performer. So luxury women's clothing retailer that's growing very, very quickly, especially in the United States. So that's not something you see from Canadian companies. Usually they have trouble expanding to other regions, especially in the States. Like, Canadian Tire failed to do it. Tim Hortons failed to do it. So this might be the one that actually gets there. And, it could be the next Lululemon in terms of just a success story. So very excited with this one. I think it's fairly valued at the moment. So that's why I'm not adding to this one, because I think there are other stocks in the market that are presenting a better buying opportunity than Aritzia. Even though I love the company, I don't think paying even the current price is a terrible idea. But of course, compare your options out there. For Brookfield, just down slightly, but it has recovered a lot from the low 50s back up to the high 50s, almost $60. So they're going to be doing their spinoff of their asset management business. So for each 4 shares of Brookfield Asset Management you own, you will get 1 share of the new spinoff that they're going to be doing later in the year. So they approved that on November 9th. For Scotiabank, I just bought a little bit more fractionally, just from some dividends I earned. So just rolled a little bit more into here. For Costco, this is my other consumer defensive. So I really like global consumer defensive companies. I think they just have more growth potential than something like Loblaws, for instance, which is only in Canada. And it will continue to grow into the future, just because food is going to continue to increase in price, and they can pass any rise in costs on to the customer. That's one thing I really love about these kind of stocks, is that no matter what happens to the economy, we could be in a horrible depression, people cannot cut their food budget. You must eat. So Costco is kind of just one of these companies, but they're international, so they can grow a lot more in the future. For ENS, that's just an alternative way to invest in Enbridge. So this is just paying me like about a 10.5% yield. It pays me every month. So we're in the green on this one, performing very well. So really like this one. Crypto is basically, destroyed. It's been kind of hovering around this, negative 60%. We have these, crypto exchanges closing down. So a lot of people are a little bit distrusting and a little bit apprehensive towards cryptocurrencies right now. So I'm not sure what's going to happen. Again, this is just a very small position, very minor for me. It's like 0.5% of my portfolio. So I'm not too concerned about this one. This one's kind of just for fun. I'm not going to add like tons of money into this. If it grows, great. If it doesn't, it doesn't. That's okay. So for Google, this one is also down a little bit. So this was in the low 80s. It's actually recovered back up to around the $9,800 range, so not too bad. I'm back into Granite Real Estate Investment Trust, so I repurchased my position back into this company. I did hold it earlier in the year. I sold it off actually at $98. Because the banks were in decline at the time, like TD and Scotia went down immensely. So I decided to sell Granite because it held up really well at the time. And I just bought into Scotia and TD, and they held up better than Granite. So kind of lucky timing on my part, I'm going to say. But at these prices, I really like it. So if you're not familiar with this one, it's a real estate investment trust. And they own warehouses and factories. And they own a lot of them in Canada, the US, and Europe. So you're globally diversified with this business. So I want to start growing this holding, especially while it's at these attractive levels in the 70 range. So I'll probably be doing another buy later, getting another share. And I also have a little bit of a fractional here because I got paid $5.40 from Smart Centers this month, and I just rolled that into a fractional share of Granite. So I'm just going to be continuing to do that. I want to get Granite and Smart Centers up to an even weighting. For H yield, I just reinvested my dividend, so I got about $26 dividend this month. I reinvested it back into HYLD, so we're up to 191 shares. So we increased our passive income in the portfolio by 28 cents, basically in perpetuity. So every single month for just compounding this ETF, and then with the remainder, I'm throwing the fractional into whatever other opportunity I think is good. So banks look good, tech sector looks pretty decent. Overall, not too bad. Intel's recovered from the mid 20s, nearly back up to 30. So this one's doing okay. Microsoft is recovering. It was in the low 200s, and now it's in the mid 200s. No concern over this one. POW is also holding on strong at $33 a share. So they own a lot of insurance businesses, and they own WealthSimple. So that's one thing that I really like about them. This kind of sets them apart from the other insurance companies. It's just a holdings company that owns a lot of businesses. So if you haven't started investing yet, you can use my link for WealthSimple in the description below. And if you sign up and make a deposit, you can get the value of up to $3,000 in cash. So that can definitely give you a great start to an investment portfolio. So feel free if you haven't yet. Just because, in a down market, that's the best time to be buying. You don't want to be buying when everything is going up. You're not getting as many shares. You're not reinvesting your dividends into more shares. So you get fewer shares in a rising market from your dividends. So that's why I kind of prefer a down market. You accelerate your wealth much more, as long as you just realize that you're holding these assets to get a dividend, a source of income, and not pay so much attention to the stock price, because that's something that could really, really cause you a lot of anxiety. And that's why I really like dividend investing, just because I know that I'm getting cash flow. It doesn't matter that the market's offering me, $26 for my Smart Centers REIT. If I think it's worth 30, I'm not going to sell it for less, right? Especially if I'm not needing the money desperately, or if this account is going to be untouched for the next 30 years. I'm just going to keep reinvesting my dividends, making my deposits, just staying consistent and increasing my income over time. And then TELUS is also in the green by a little bit. So this one has been solid. I really, really like this telecom. It's just been very consistent. All their earnings reports are fantastic. And they continue raising their dividend twice a year. It's what I want to see. And they have a goal to raise it by 7 to 10% until 2025 annually. So great dividend grower, very diversified, not in the telecom space. And I really like that, unlike Rogers and Bell, they don't really have a cable television network that they have, because that is going to be a declining sector. So that's something I really like about TELUS. They're in agriculture, healthcare, other businesses that have great futures. TD Bank, I just bought a little bit more fractionally. This one's actually held up pretty well. relative to the rest of the banking sector. So just a little bit more fractional buys here. Really like TD. I mean, I wish it went on a big discount like Scotiabank. Unfortunately, it didn't happen, so that's why I've been buying a lot more Scotiabank, but I definitely want some TD just to balance out that position. I kind of want an even holding of TD and Scotia. And then for the final purchase of since the last update, I bought a little bit more Tesla. So it's been like touching 52-week lows. So I bought about 20% of a share. So we went up to 1.3 shares of Tesla. I really think at these levels, it's kind of pretty fairly valued. And I think there's just a bit more potential for upside than downside at this rate, because in my valuations of the company, I'm really not giving any credit to self-driving. I'm not giving any credit to the energy business or the supercharger network or anything else that they're working on, because I'm just purely looking at it as a car business. I have no idea what Tesla will get into next. They are a data company. I understand they're more than a car company, but I don't know in the next 5 years what they're going to accomplish to a reasonable degree. And that's why I'm going to be a little bit skeptical and kind of, say that they're worth about anywhere from 160 to 220, which is quite a big range. If it were to fall more, I would definitely feel more confident purchasing more Tesla. But as it is right now, I'm pretty happy with where it's at. I'll be adding a little bit more here and there if it's going to stay at these levels. And for the dividends earned since the last update, I've earned $936.17 in dividends since starting the portfolio back in February of 2021. Annually, our portfolio has increased from the previous update. So last time was $900.99. Now we're making $908.63. So nice little increase there for the annual dividends. Monthly, we went up from $75.08 to $75.72. Weekly, we're making $17.47 in dividends. Last time it was $17.33. And on the daily average, we increased that by 2 cents a day. So from $2.47 to $2.49 a day. And the months to earn $100 has decreased yet again from 1.33 months to 1.32. So less than a month and a third of a month to earn $100 in dividends. That's how I'm tracking the snowball effect or the compounding effect of my portfolio as this number just shrinks and shrinks over time. And our portfolio got a raise from work. So it for a 40-hour work week, it went from 43 cents an hour to 44 cents an hour. So this is money I don't have to clock in at work for, and my portfolio is just passively doing this as I sleep 24/7, just going out there. Money just shows up in my account. So I just have to do my part, which is just making regular deposits, reinvesting my dividends, and then just increasing the cash flow that I receive from month to month to eventually reach my financial goals, which is to, supplement my income. Retiring early would be nice, but I think just having a goal to retire at all is a great goal, just because we have a lot of people in Canada especially, or a lot of Americans that, have to get jobs in their 70s, and they don't get to retire because they're not thinking about investing. A lot of people are living paycheck to paycheck and not really putting money towards their retirement because, your Canada pension plan or your Social Security, it's not enough to support you fully. So you definitely need to have your own contribution that you wanna put towards that as you work through life and as you near the retirement age. And for the goals in the portfolio, the next goals I want to accomplish are $3 a day in dividends. So we are getting closer to that. We're almost at $2.50. So we're going to get closer to this, especially since we're earning about $75 a month on average. This should come sooner rather than later. I want to average $100 a month in dividends. So we're at 75. So we're about 3/4 of the way there. And then I want to receive about $1,000 in annual dividend income. So we're at 908. So we're not too far off from that goal. And just seeing these charts from month to month just having a growing stream of passive income. This is really what makes me happy to look at, especially when the market isn't, just going up in a straight line. It's not always going to do that. It's going to vary. Some years are going to be bad. Some years are going to be good. But overall, you should expect a positive return, assuming you're investing in quality assets, quality stocks, or just a good solid ETF. So we went from 50. So from April to July to October, you can see that my largest paying months have just been increasing: 76, 87, 100. For November so far, we've earned 58. If we compare it to the previous year, like the highest month was $45. The lowest paying months were like $8, $9. So huge increase, because the floor for 2022 was about $37.94. So not too bad there. And if we look at the dividends earned year over year, we can see that for 2021, I earned $261 in dividends. For 2022 so far, I've earned $674.37. Now, I have received most of my dividends for November, but there's still going to be some more dividends earned in December. So I expect 2022 to be way over $700. So we've almost tripled the amount of dividends earned in just a single year of investing, which is fantastic to see. In the comments below, just let me know, what do you think about AQN? Are you invested in it? Are you selling out of it? Just let me know what you think about AQN. All right, have a great day, everybody.